Now, I think this is the most important part out of this entire video. This is really the grand slam reason why we will see a pullback, correction, or crash-like event over the next couple of weeks. Here in this video, we will be going over whether or not I believe AMC Stock will go through a MOASS-like event in 2024. But in the first segment of this video, we are going to talk about the broader markets and what could be coming next and really throughout 2024, because it looks like a crash may be upon us. Stocks are going to crash. Ladies and gentlemen, this sounds very different than what you will hear from other Wall Street analysts, investment advisors, bankers, and even retail investors as of lately. This is not the base case outlook from market participants. Betting on a crash or correction-like event here in the short term is actually the contrarian bet, which tends to be the right one. It's important to note that I think a crash is coming in the near term, but the historical reference that we have is this year's probably going to end on a strong note. Seth Golden shares this on X. When a down year, like 2022, is followed by an up year, like 2023, markets tend to keep going up the next year, about 86% of the time, and the median return is about 13%. But in the near term, like the next couple of weeks, things could get quite ugly for stocks. There's really a couple different reasons for this. My consensus is pretty strong, and I don't think I'm going to be wrong here. Number one is the first quarter of any given year is by far the most important because that's when you get the most long-term guidance issuances. S&P 500 EPS growth is expected to be around 11% in 2024. That's high for any normal year, let alone an election year, let alone a year in which we have high degrees of uncertainty around the economy, around inflation, around Fed policy. During a year in which the unemployment rate is likely to rise, after all, it can only fall so low, and you're already at 3.7%. I mean, does it go lower than that? It could, but that's unlikely. Major retailers like Walmart, Target, Dollar General, a lot of different companies, but specifically I like to pay attention to the retailers. They've said on their last earnings that we should expect deflation coming over the next couple of months. You know what that's bad for? Company earnings. So if the markets are pricing in 11% EPS growth for the S&P 500 and you're trading at all-time highs on the SPY, there's not a lot of room for error. Normally, around 70% of the time, the markets actually beat Wall Street's estimates for S&P 500 EPS growth. So to be 11%, you're going to have to come in higher than that, and that just seems very unlikely to me. Something else that has been notable over the past couple of days, trading days that is, on Thursday we had the CPI report that came out. Hotter than expected. What happened? 2-year Treasury yields plummeted. Why would that happen? If anything, you would expect 2-year Treasury yields to stay flat, if not even go higher, implying the Fed is going to stay the course and continue to fight inflation. As you know, as the hot inflation reports, the start of what could be multiple hot inflation reports. That's not what I expect, but that's the logic the market should have went with. Instead, the market's priced in more rate cuts. The markets last week on Monday were pricing in 7 rate cuts at a 18.3% chance. You can see that right here, the previous week probability. By Friday, after the hot inflation report, you are now pricing in 7 rate cuts at 39.3% odds, and that's still where we stand. The odds of 8 rate cuts on Monday of last week was 1.1%, basically not even a probability. Now, it's almost 20%. That, my friends, is telling you something. The markets are not expecting more rate cuts because inflation is falling faster than expected. They're expecting more rate cuts because, well, the economy could be worsening and weakening faster than what we expect. Coinciding the fall in 2-year treasuries, the 10-2 yield curve inversion is starting to steepen. Typically, when you uninvert, that's when you get the pain in the markets, is as the yield curve goes from inverted to uninverting, that's when people tend to freak out, and that's when stocks tend to fall. No wonder why interest rate sensitive names have been falling over the past couple of weeks. Well, you've been uninverting on the yield curves. Specifically, when you get positive again, you usually have about 5 months on average until a recession is here. So if it takes 2 declining quarters of GDP to be technically in a recession, that could mean we're already in a recession right now. Now, I think a lot of this is algorithmic based. It's kind of what it seems like, but still, it doesn't change the fact as we are uninverting, the markets have been falling. Not the indexes, not Apple or Google or Microsoft or Amazon or Nvidia or Meta, your interest rate sensitive names, your most sensitive stocks, high quality names at that, but they have not been doing well. This market, again, is getting very top heavy. And what happens in a top heavy market is you either get the top heavy stocks, Magnificent Seven for lack of a better word, coming down to matching smaller cap, more average stocks, or you get your average stocks catching up to big tech. This does not feel like we're going to see a catch up in markets unless we start getting really good economic data, unless we start getting really good earnings, and we continue to see inflation fall like a rock. The odds that we get all of those things coming together seem very slim right now. The biggest potential risk for 2024 is whether or not we actually do go into a recession, whether we start to get negative jobs reports, whether the data starts to look really bad. For what I'm talking about right now, correction like event, maybe 10% down from here on the SPY over the next couple of weeks. That doesn't have to happen to give you a 10% correction. You can get bad earnings, you can get some more profit taking, selling off of big tech, maybe some bad retail sales data coming out next week. You don't have to see the worst case scenario. Like if we go into a recession, you're going to fall more than 10%. Good news is, and I actually kind of believe Goldman Sachs here, Goldman Sachs says something finally breaking due to higher interest rates is unlikely at this point because the peak growth hit from higher rates and tighter financial conditions is well behind us. So Goldman Sachs basically says we've been going through this for a while. If something massive was going to break, it probably would have already broke by now. And in fact, something did break. That was the regional banks. And what happened? The Fed came in with a $400 billion stimmy check and bailed them all out, and that crisis is now over with. Apollo Asset Management says, quote, the record high $6 trillion in money market accounts is likely to be a tailwind to equities, credit, and rates, and ultimately the economy, in particular hiring, housing, and inflation. I agree with this to a certain extent as well. $6 trillion of investable cash on the sidelines is a lot. For context here, the entire market cap of the Russell 2000 is around $2.5 trillion, less than the market cap of Apple or Microsoft. It's not going to take a lot of money heading into your average stock to get the markets really moving here. And I expect that will happen at some point towards the mid to late part of 2024. Also, this might come to some of you guys as a surprise, but on average, when the Fed does cut rates the first time, which we're currently pricing in for March, unless something crazy were to happen and the Fed just utterly destroys the markets coming on January 31st. We'll talk about that in just a moment. You typically do see a fall in markets upon the first rate cut. And the fall tends to actually be more than a fall. It tends to be a full-on crash. On average, you fall 23.5%, and it takes 195 days to bottom on average following the first Fed rate cut. Okay, and it's actually pretty simple, and I'm going to explain this as easy as I possibly can. We are expecting 7 rate cuts in 2024. That implies one of two things happening. That implies inflation is going to fall quickly in 2024, or that implies that we are going to see the economy weakening. So coming on January 31st, the next Fed meeting, no, we're not expecting a rate cut then, but by March we are. And if you're not seeing progress on either the economy worsening or inflation getting better, which we're not going to get another CPI report before January 31st. So really, unless the economy just collapses, then the Fed's not going to reinform this 7 rate cut thesis that the markets currently have for 2024. So as of right now, it looks certain that we are going to get a hawkish Jerome Powell coming January 31st. Every single one of the Fed speakers that we have heard speak so far since the last Fed meeting, none of them are even close to where the markets are currently pricing for the amount of rate cuts. Most Fed officials are at like 2 or 3 rate cuts for 2024. So that is what I know definitively. We're not going to get this bullish Jerome Powell January 31st, and that's a problem because some stocks are trading off of we're going to get 7 rate cuts and we're going to have a good economy. The only way that happens is if inflation just plummets, and that's not happening, at least from the data that we just got Thursday. And actually, in a weird, perverse way, you might actually need to see rate cuts from the Fed to lower inflation even more. So here's a pretty good chart to look at things. Where you had the inflation in 2021 and most of 2022 was core goods. Now, core services x shelter has started to get better. Food is basically gone. There's very little inflation in food, and there's basically no inflation in core goods, almost deflation there. Energy is not a problem. It's basically all in shelter right now. And you can see 2021, there was no problem with shelter inflation, which this makes a lot of sense if people are not able to buy rentals for, a reasonable monthly payment, right? Assuming you're getting a mortgage, you're going to have to charge even more than that to rent out a house. A $100,000 house is going to cost you like $1,200, around $1,200 for your mortgage payment. I mean, you're going to have to charge like $1,500 at least for rent. If rates start to fall, people can refinance, get lower prices for their mortgage, and potentially charge less for rent. That's just how these things work. I own 3 different rental properties right now. One of them is a 4-unit, and that's just the way it goes. But maybe the Fed ultimately capitulates and understands this. Who knows? But even what you heard from Fed Mester on Friday, she says December CPI shows the job isn't done yet. So back to my point, January 31st is going to be rough, but what you're going to have this same week as well is Apple, Microsoft, Google, your other big tech names besides Tesla and Netflix. You're going to have Meta that week. All of really your important earnings, most of the S&P 500 reporting the same week as Fed Jerome Powell. And you guys will probably hear me say this multiple times if you have not already, but the markets can handle bad news exceptionally well. The markets can get over bad news like nobody's business. The markets cannot handle uncertainty. And we're setting ourselves up for a lot of uncertainty here over the next couple of weeks. And my 8-month-old son is teething in the background, and I'm a father of 2 with no help at all. So unfortunately, we have to deal with that. At least hopefully it does not throw off the quality of the information provided. But back to what I was saying is the rest of 2024, after some kind of crash or correction event, I'm actually a lot more bullish on. In the grand scope of things, this is actually pretty typical. You normally get a pullback in the first couple months of a year after a 20% gain. So 2023, you had a 24% gain on the S&P. You tend to pull back the first 3 months or so of the next year. And then you tend to return over 10% for the entirety of the year. Most of this actually happening towards the end of the year, October through December. Also, as you can see here from Ryan Dietrich's post on X, he says, did you know that stocks have gained in a pre-election year and election year after a negative midterm year every time since 1950? That is 17 for 17. And do you really think 2024 is going to beat that streak? Well, probably not. Now, this is actually pretty common as well, but you tend to see a pullback in the first 3 months of an election year. And stocks don't really tend to do much until after like June. So, in a nutshell, it doesn't seem like the economy is going to rapidly deteriorate between now and January 31st. We have some data coming out next week and the week after that, but nothing that should be too bad. Now, ultimately, I think that's a risk to our markets. I think bad economic data, more rate cuts is not a good thing. That's why I'm a little confused why the markets in general are doing well or doing okay when we're pricing in 7 rate cuts, and that's almost certainly going to mean a recession. But maybe that's a topic for another video, or at least a longer video. The point here is earnings are coming, which likely are going to disappoint, maybe not too bad of earnings, but you have to have some really stellar earnings to appease this market right now, considering stocks are at all-time highs. If you're looking at the SPY, your average stock is obviously not there, but Magnificent Seven leading the way yet again. The biggest surefire danger that we have is January 31st. I mean, January 31st, it's not set up to be a good presser from Fed Jerome Powell. Fed Jerome Powell is going to have to push back on the rate cut in March. If he doesn't do that, he's for sure going to push back on 7 or 8 rate cuts. He's going to firmly say there's no way that we are going to get that many rate cuts unless the economy gets way worse from here. And that's ultimately not a good thing as well. So I think whether it's earnings or most definitely the Fed, in my personal opinion, that will give you downside and could be substantial. And it could be substantial downside because of where stocks are. If stocks were down here, SPY at 440, maybe that downside wouldn't be so large. But considering stocks are almost 480 on the SPY, that opens the door for, larger downside than what we would typically expect. Something else that is also notable is the 50-cent trader. He or she is a mysterious figure. We talked about this in the last video, but if you missed it, we'll give you a recap here. They tend to go long on the VIX, which long, like buying calls, means they expect the markets to fall, or buying puts on the VIX, expecting the markets to rally, precisely right at the perfect time. Now, they go in on very short-term, large bets. We don't know who this is. It could be anyone. They're back. Now, they only surface once a year, once every couple of years. And they're back now. This VIX trader dropped $17 million and bought 250,000 call contracts on the VIX with a strike price of 17. This trader spent between 63 and 67 cents a contract, $63 to $67 per contract, almost $17 million they put on. These contracts expire by February 14th. So, the Fed, we're actually going to get CPI on February 13th as well. So these contracts cover quite a bit of potential downside catalysts for our markets. The biggest one of which, again, being the Fed, in my personal opinion, on January 31st. But Steve Stosnik, chief strategist at Interactive Brokers, says, quote, "It's hard to know if it's an outright bearish bet on the markets or an aggressive portfolio hedge after a big move." He says either way, it expresses concern that we could see a bit of a pullback during or after earnings season. Now, personally, just throwing out numbers here is a little bit speculative, right? I expect we're going to get some downside. Do I know to what degree that is going to be? No. I think if the Fed is negative, which that's my base case coming January 31st, I think they're really going to push back on 7 rate cuts, and I think the markets are not, expecting that. Now, to the contrary, if Fed Jerome Powell, reinforces 7 rate cuts, but they say the economy is going to get a lot worse, that is also very, very bad news as well. Now, if earnings are negative, if earnings are bad, that's where you could see a larger drop. If earnings theoretically are bad, the Fed is negative, you could see the S&P, in my opinion, fall all the way back to the October lows of 2023, not the October lows of 2022. That would be, a more so recessionary-like event. But falling back to the October lows would be a fall of about 15% from here, which I really don't think is too unrealistic. Now, if things are just kind of medium bad, I think the S&P could easily fall back to about 440. If things are just a little bit bad, let's say earnings are a little bad, but the Fed is neutral or bullish, then I think the S&P still falls to about 450, maybe 460. That would still be anywhere from 4% to 5% lower from here. So let me know what you guys think down below in the comment section. Are you bullish? Are you bearish? Do you kind of have the same mentality or logic that I have right now, where the near term things look like they could get worse, but maybe for 2024 as a whole, you think things are actually going to be pretty good by the end of the year? At least that's what I'm leaning towards as of right now. Now, with all of that being said with AMC stock, I think that's important because I think in the near term, we're in for a bit of a problem. Now, to the main theory of what I have been saying for a while now, I think we're going to get a commitment that Adam Aron will not dilute shareholders. Maybe, just maybe, we don't get that commitment until June. Let's say the second half of the year when things start to look a little bit better out there. Maybe more money's coming in the markets from money market funds. Maybe AMC's doing a little bit better than Wall Street analysts had expected. Well, if we were to get that commitment, theoretically, we're just choosing dates here, June 1st, and let's say markets do exceptionally well towards the back half of 2024, those two factors together could give you quite a rally in AMC stock. Now, I believe AMC stock is 100% sold short. So I think that will also play into it, but you do need to see some form of kind of euphoric market rally, a catalyst to get shorts covering, something else to get a MOASS-like event. But to see AMC go to $20, $30, $40, $50 per share, I don't think you need to see a MOASS-like event for that. I just think you need to see, what I just outlined. Money coming back into the markets. I think you need to see the Fed, right, being accommodative to the markets. I think you need to see the economy avoiding a recession. And I think you need to see at least a commitment from Adam Aron that we will not be diluting shareholders. Unfortunately, if that commitment happens here in the near term, it might not help a lot for AMC if we do go through some form of market downside here. Now, I will tell you, AMC stock is not trading as a meme stock anymore. It's not trading as it used to. So there's really not much premium. If you're buying the stock here, the stock is now under $1 billion market cap. And the risk to reward looks a lot more favorable now than it really ever has before. I mean, I can't think of many other times where, it was this attractive to get into AMC. Like, you're buying the stock at the bottom of the barrel, right? We know AMC can be aggressive. And I think a lot of people are counting the stock out right now when I don't think that's the right way to go about it. Things can change, though. Keep in mind, I don't know for certain. Adam Aron could come out and say, we're diluting 50 million more shares onto the markets. At that point, that's going to be difficult because every dollar you fall from here, it's going to make it that much harder for a MOASS-like event, or even to get to 20 or 30 or 40 or $50 per share. Because think about it like this. I used this example in the last video, right? But if AMC, or one of the last videos, if AMC is $1 per share, let's say you want to get the stock to $100. You have to see a 100x. That's a lot. That's pretty difficult. That's 10,000% of a return of 10,000%. Now, if you want to, take the stock from $5 to $100, that's only a 20x. And the only difference there is $4. So the higher the price, the easier it will be for AMC stock to make a large gain. The lower the price of AMC, the harder it will be for AMC to catch that traction again and really make that move to the upside. Now, who knows? Maybe we get a really good catalyst. Maybe we get a potential, even buyout at this point. Who knows what could happen? There's a lot of different things going on, but I do think the back half of this year is going to be a lot more fruitful than the first half of the year. And I wouldn't have high expectations for the first half of the year at all. Maybe when we get towards like back half of April or May even, you could start to get a little bit more clarity on how the economy is going to be, the Fed and all of that. But right now there's not a lot of clarity on much. But the things we do know is the near term, the next couple of weeks, probably going to be pretty bad for stocks. That's just my honest opinion. So thank you for watching. Enjoy the rest of your day. Let me know what you think about this information down below in the comment section. You guys have a great rest of your day, and I will see you in the next one.